Warren Buffett and his opinion about tech stocks. Alright, so we've established in my previous videos that Warren Buffett is not really interested in the whole crypto craze. But what about the tech stocks that we talk about all the time here on this channel? Well, this may come as a big surprise, even though at this point it really shouldn't, but he is not so optimistic about investing in them either. Hello everyone and welcome back to my channel. Before we begin, I've got the usual request for you. If you like my content, please don't forget to give it a thumbs up, share it with your friends and maybe drop me a comment below. Thank you. Now, let's get on with what we've all come here to see, Warren Buffett's opinion of tech stocks. In Buffett's own words, we are perfectly willing to trade away a big payoff for a certain payoff. And that is the big difference between people like Buffett and the majority of the tech positive investors. Buffett likes to put his money into the things he knows have been working for decades. These are the really safe bets, and for someone who has been around the investing scene for as long as him, it's these companies that present the real stability. I really feel like I'm repeating myself, but long-term investing is about holding positions for the long term. If I, as a long-term investor, can't judge whether a business will be successful a decade from now, it is better to put my money elsewhere. This can come from any number of things. It could be because I don't understand the field, the product, the business model, the management choices. Of course, I didn't come up with all of this myself. In long-term investing, you don't need to reinvent the wheel. People have already figured out how the system works. You just need to understand the strategies and find the ones that work for you. Similarly, someone like Buffett will prefer to promise of long-term that comes with the companies that he understands. Companies which are not positioned in fields that changes rapidly as tech does. When a tech company comes out of nowhere and makes it big, people usually call it a miracle. And Buffett doesn't want to put his money on miracles coming to reality. But enough of my point of view. Let's hear it from the man himself.
We don't think of whether we should be in tech companies or not or that sort of thing. We are looking for things where we do get into the durability of the competitive advantage. What Jeff Bezos has done is something close to a miracle, and the problem is if I think something will be a miracle, I tend not to bet on it.
But we are perfectly willing to trade away a big payoff for a certain payoff, and that's the way we're put together.
Well, this technology is a killer as well as an opportunity. And my first experience, it damn near killed me.
We've never lost that much money on any one investment, but it's the things that I knew enough to do that I didn't do. We have missed profits of as much as, maybe $10 billion in things. I've not felt the confidence that I was the best one to judge that in many cases. I made the wrong decision on Google and Amazon.
Yeah, we have a wonderful system. If one of us is stupid in some area, so is the other. I've been to Google headquarters. They look to me like it looks like a kindergarten.
There is no penalty in investing if you don't swing a ball that's in the strike zone, as long as you swing at something at some point, and eventually that you find the pitches you like. And
I'm wondering about your interest in not just Apple, but all of the tech stocks like Amazon and Google, because you've avoided them, you stated in the past, because they're complicated, you should stick with something you understand. On the other hand, Amazon and Google have what you call a very durable competitive advantage. They really hardly have any competitor. And that's true in China too, of Alibaba and Tencent. So it seems like it's a conflict, and I'm wondering if you're going to be turning the corner and going into these tech companies that seem to have no serious competition.
Well, we certainly looked at them, and we don't think of whether we should be in tech companies or not or that sort of thing. We are looking for things where we do get into the durability of the competitive advantage, and whether we think that our opinion might be better than other people's opinion in assessing the probability of the durability, so to speak. But the truth is that I've watched Amazon from the start, and I think what Jeff Bezos has done is something close to a miracle. And the problem is, if I think something will be a miracle, I tend not to bet on it. It would have been better, far better, obviously, if I'd had some insights into certain businesses. But in fact, Bill Gates told me early on, that I think I was on AltaVista, and he suggested I turn to Google. But the trouble is, I saw that Google was skipping past AltaVista, and then I wondered if anybody could skip past Google. And I saw at Geico that we were paying a lot of money for something that cost them nothing incrementally. So we've looked at it, and I made a mistake in not being able to come to a conclusion where I really felt that at the present prices that the prospects were far better than the prices indicated. And I didn't go into Apple because it was a tech stock in the least. I went into Apple because I came to certain conclusions about both the intelligence with the capital would be employed, but more important, about the value of an ecosystem and how permanent that ecosystem could be and what the threats were to it and a whole bunch of things. And I don't think that required me to take apart an iPhone or something and figure out what all the components were or anything. It's much more the nature of consumer behavior. And some things strike me as having a lot more permanence than others. But the answer is, I'll miss a lot of things that I don't feel I understand well enough. And there is no penalty in investing if you don't swing a ball that's in the strike zone, as long as you swing at something at some point, and eventually that you find the pitches you like. And that's the way we'll continue to do it. We'll try to stay within our circle of competence. And Charlie and I generally agree on sort of where that circle ends, and what kind of situations where we might have some kind of an edge in our reasoning or our experience or something, that where we might evaluate something differently than other people. But the answer is we're going to miss a lot of things. Charlie?
Yeah, we have a wonderful system. If one of us is stupid in some area, so is the other. And of course, we were not ideally located to be high-tech wizards. How many people of our age quickly mastered Google? I've been to Google headquarters. They look to me like it looks like a kindergarten.
A very rich kindergarten.
Yes.
No, it's extraordinarily impressive what they've done. And like I say, at Geico, we were paying them a lot of money at the time they went public. And all three of them, the main characters, Eric and Larry and Sergey, they actually came and saw me, but they were more interested in talking about going public and the mechanics of it and various things along that line. But it wasn't like what they were doing was a mystery to me. The mystery was how much competition would come along and how effective they would be. and whether it would be a game where 4 or 5 people were slugging it out without making as much money as they could if one company dominated. Those are tough decisions to make. You can have industries where there's only 2 people in it, and they still aren't very, very good because they beat each other's brains out. And that's one of the questions in the airline business. It's a better business now than it used to be, but it used to be suicide. So, and you know that the competitive factors are extraordinary in airlines. And how much better business is it with 4 people operating at 85% capacity than it was with 7 or 8 operating in the mid-70s and with more planes around? Those are tough decisions, but I made the wrong decision on Google and Amazon. I really consider that a miracle that you could be doing Amazon Web Services and changing retail at the same time without enormous amounts of capital, and do it with the speed and effectiveness of what Amazon has done. I underestimated. I had a very, very, very high opinion of Jeff's ability when I first met him, and I underestimated him. Charlie?
Well, my comment would be that the shareholders have one thing to be thankful for. Some of the age-related stupidity at headquarters has been ameliorated by Ted and Todd joining us. We are looking at the world with the aid of some younger eyes now, and they've had a contribution
Significant.
beyond their own investments. And so you're very lucky to have them, you shareholders, because there's a lot of ignorance in the older generation that needs removal.
Mr. Buffett and Mr. Munger. Hi, my name is Daphne. I'm from New York, and I'm 9 years old. And I'm excited to be at the Berkshire meeting, and this is my 3rd year.
Wow. You should be rich by now.
You have often said that investors are well served by identifying business with a wide moat, where the castle behind the moat is run by a king or queen who can be trusted to make good decisions. In the past, you have applied this advice by investing in businesses with world-class strong brands such as Coke, American Express, and Seas, as well as media companies that has helped these brands protect and widen their moats, such as Cap Cities, ABC, and the Washington Post. In the past, you have also generally avoided investing in technology companies, pointing out how quickly technology changes and how hard it is to build a circle of competence in it. Today, we seem to be in a world where some of the most dominant companies in the world are technology companies, and we have built powerful platforms such as Amazon, Google, Facebook, and Microsoft in America, and Alibaba and Tencent in China. These companies all have wide moats, strong brands, and are led by brilliant and entrepreneurs.
That's good.
My question to you is this. If Berkshire is to honor its tradition of investing in wide moats and strong brands, and especially in companies that are also capital efficient, do you think that Berkshire needs to expand its investing lens to include more of these leading technology platforms? In other words, do you believe that you need to adapt your model of wide moats and strong brands to embrace, not avoid, technology?
I think the answer is maybe.
I think the answer is to put her on the board, and it'll bring down the average age enormously. We won't get criticized as much. You're exactly right in that we do like moats, and we used to be able to identify them in a newspaper that was the only newspaper in town, or in TV stations where we felt the dominant positions, and we felt the product was underpriced in terms of advertising. We saw it in brands sometimes, and it is true that in the tech world, if you can build a moat, it can be incredibly valuable. I've not felt the confidence that I was the best one to judge that in many cases. It wasn't hard to figure out who was winning at any given time or what their business was about, but there were a huge number of people that knew more about the game than I did. And we don't want to try and win at a game we don't understand. We may hire people, such as Ted and Todd, that are better at understanding certain areas of investing than I am, or maybe even Charlie is. But the principles haven't changed. You're right that some of the old ones have lost their moat, and you're right that there are going to be companies in the future that have them that will be enormously valuable, and we hope we can identify one every now and then, but we'll still stay within where we think we know what we're doing, and obviously we'll make mistakes even within that area. But we won't go into something because somebody else tells us it's a good thing to do. I mean, we are not going to subcontract your money to somebody else's judgment. You can take your money and follow somebody else's judgment, but we're not in the business of thinking that if we hire 10 people with specialties in this area or that it will lead to superior investment results. And we do worry that we could blow a lot of money that way. So we'll do our best to enlarge the circle of competence of the people at Berkshire so that we don't miss so many. But we'll miss a lot in the future. We missed a lot in the past. The main thing to do is to find things where our batting average is going to be high. And if we miss the biggest ones, that really doesn't bother us as long as the things we do with money work out okay. Charlie?
Well, I think we've still got an awful lot of companies with big moats, and a lot of them are and some of our industrial brands were just incredibly strong in the niches we're in. So the Berkshire shareholders don't need to worry about we're just one big morass of unprofitability or anything like that. But we have not covered ourselves with glory in the new fields.
We won't end up all in buggy whips, though, or anything of it. But it's a very good question, and it's what we focus on all of the time. And
we're trying to improve.
And we hope we see you back here for your fourth next year.
Question on technology and company's biggest holding now. Given that Apple is now our largest holding, tell us more about your thinking. What do you think about the regulatory challenges the company faces, for example? Spotify has filed a complaint against Apple in Europe on antitrust grounds. Elizabeth Warren has proposed ending Apple's control over the App Store, which would impact the company's strategy to increase its services businesses. Are these criticisms fair?
Yeah. Well, again, I will tell you that all of the points you've made, I'm aware of, and I like our Apple holdings very much. I mean, it is our largest holdings. And actually, what hurts in the case of Apple is that the stock has gone up. And we'd much rather have the stock. And I'm not proposing anything be done about it, but we'd much rather have the stock at a lower price so we could buy more stock. And importantly, if Apple, I think they authorized another $75 billion the other day, but let's say they're going to spend $100 billion in buying in their stock in the next 3 years. It's very simple. If they buy it at 200, they're going to get 500 million shares. They've got 4 billion, 600 million out now, and so they'll end up with 4.1 billion under that circumstance. If they're buying it at 150, they buy in 667 million shares. And instead of owning what we would own the first case, now the divisor would be less than 4 billion, and we'd own a greater percentage of it. So in effect, a major portion of earnings, at least possibly, it's at least been authorized, will be spent in terms of increasing our ownership without us paying out a dime, which I love for a business, a wonderful business. And the recent development, when the stock has moved up substantially, actually hurts Berkshire over time. We'll still do, in my opinion, we'll do fine, but we're not going to get into, we're not going to dissect our expectations about Apple, for people who may be buying it against us tomorrow or something. We don't give away investment advice on that for nothing. But we have all the things you've mentioned. Obviously, we know about. We know we've got a whole bunch of other variables that we crank into it, and we like the fact that it's our largest holding. Charlie?
Well, in my family, the people who have Apple phones, it's the last thing they'll give up.
Not a bad item to have.
I know you like to buy into success stories, but you don't like to buy high tech. And it seems to me, say, in the case of Microsoft, that 10 years from now, they'll be doing software development, just like 10 years from now, Coke will be selling sugared water. And what I'm wondering is why you feel that way when it seems certain companies, high-tech companies, are predictable. And it also seems that in the early 90s, you mentioned you were going to buy a pharmaceutical company, which also seems like high-tech to me. So that's my question.
Yeah, well, I think we said that with the pharmaceutical companies, we wouldn't have known how to pick out which one. We would have thought the industry as a group would do well. From those levels of 1993, you cannot buy high-tech companies at anything like at levels that are commensurate with the levels that the pharmaceutical companies were selling at in 93. I would, and getting to the first part of your question, I think it's much easier to predict the relative strength that Coke will enjoy in the soft drink world than the amount of strength that Microsoft will possess in the software world. That's not to knock Microsoft at all. If I had to bet on anybody, I'd certainly bet on Microsoft, bet heavily if I had to bet, but I don't have to bet. And I don't see that world as clearly as I see the soft drink world. Now, somebody that has a lot of familiarity with software may very well see it that way, and they're entitled to, if it's true they have superior knowledge and they act on it, they're entitled to make money from that superior knowledge. There's nothing wrong with that. I know I don't have that kind of knowledge, and I simply think, and I do think that if you have a general knowledge of business over decades, that you would regard the industry they're in as less predictable than the soft drink industry. Now, it may also be that even though it's less predictable, that there's a whole lot more money to be made, so that if you're right, that the payoff is much larger. But we are perfectly willing to trade away a big payoff for a certain payoff, and that's the way we're put together. It does not knock the ability of other people to make those decisions. I mean, I asked, first time I met Bill Gates in 1991, I said, if you're going to go away on a desert island for 10 years, you had to put your stock in two companies in the high-tech business, which would they be? And he named two very good stocks. And if I'd bought both of them, we'd have made a lot more money than we made even buying Coca-Cola. But he also would have said at the same time that if he went away, he'd rather buy Coca-Cola, because he would have felt sure about that happening. It's, different people understand different businesses, and the important thing is to know which ones you do understand and when you're operating within what I call your circle of competence. And the software business is not within my circle of competence, and I don't think it's within Charlie's. Charlie?
Well, I certainly agree with that. I think there are interesting questions too, about how far the whole field can go. Take jet airplane travel below the speed of sound. It's been pretty static in terms of the technology for a long, long time. The big Boeing airliner is much the same as it was 20 or 30 years ago. And I think a lot of these businesses are quite dependent on the technology continuing to gallop and do more and more for people. Take pharmaceuticals. If they never invented any more pharmaceuticals, it would be a terrible business. And I don't know what happens once you get unlimited bandwidth into the house and way more options. And beyond a certain point, it strikes me that there might be a surfeit of anybody's interest in the field. I don't know where that point is, whether it's 20 years out or 30 years out, but it would affect me a little.
The dilly bar is more certain
Yeah.
to be here in 10 years than any software application that we know. But that's maybe because we understand dilly bars and not software. In the whole United States, which is by far the most prosperous country in the world, the whole United States, there are probably around 400 companies, 400 total companies that are earning $200 million a year after tax. Of those 400, you can name them. I mean, you can start, if you say banks, you can say Citigroup and Chase and Wells Fargo, and you can name 10 or 15 of them. And if you name consumer goods, you can say Procter & Gamble and Coca-Cola and Gillette, and you can name a whole bunch of them. You can almost, of those 400, you can probably name 350. If 5 years from now, instead of 400 being on that list, there'll probably be 450 on the list, maybe 475. A lot of those will be companies that are earning between $150 and $200 million now. So there'll probably be 20, some number like 20 that call it come from nowhere. Now, if you look at the number of companies that are selling today at a price which implies 200 million or more of earnings right today, you will find dozens and dozens in the high-tech arena. And a very large percentage of those companies are not going to fulfill people's expectations. I can't tell you which ones, but I know there won't be dozens and dozens and dozens of those companies making a couple $100 million a year, and I know they are now selling at prices that require them to be making that much money or more. It just doesn't happen that often. Biotech was all the rage some years back. How many of those companies are making a couple $100 million a year? It just doesn't happen. It's not that easy to make lots of money in a business in a capitalistic society. There are people that are looking at what you're doing every day and trying to figure out a way to do it better and to underprice you or bring out a better product or whatever it may be. And a few companies make it. But here in the United States, after all of these decades and decades and decades of wonderful economic development, we've got about 400 companies that have hit the level that would be required of a company that would have a market cap of $3 billion. And some companies are getting $3 billion of market cap the day they come out, virtually. So you want to think about the math of all this.
I did not make my fortune, by and large, on the cutting edge of technology. My first investment was my pitiful savings of a venturesome sort. I invested in a company right in Pasadena, and it was called William Miller Instruments. And I damn near lost all my money. It was hell on earth. We just barely squeaked out with a substantial outcome. And what did us in is that the oscillograph that we'd invented and we were so proud of, and we thought it was going to knock the world flat, somebody invented magnetic tape without telling me. And by the time we got that oscillograph ready to go to market, we sold three total in the whole world, whole country. So this technology is a killer as well as an opportunity. And my first experience, it damn near killed me.
And so, but that's sort of the other part, right? Over the 75 years that you've been involved in investing.
What that did for a long time was keep me out of venture capital on the edge of technology.
But even
I tried to avoid it.
But even so, in the companies that you deal with, some of them are market leaders at one point in time, and as you just suggested, some technological change or change in preferences will lead those companies to be with less of a market than they used to have for their products. And so how does one think about this over the long term? Because it's
over the
an
long
interesting
term, the companies of America behave more like biology than they do anything else. In biology, all the individuals die, and so do all the species. It's just a question of time. And that's pretty well what happens in the economy too. All the things that were really great when I were young have receded enormously, and new things have come up, and some of them started to die. And that is what the long-term investment climate is. And it does make it very interesting. Look at what's died. All the department stores, all the newspapers, U.S. Steel, John D. Rockefeller's Standard Oil, the pale shadow of his former self. You know, it's just like biology.
So
they have their little hour, they have their little time, and then they get clobbered.
And so how does one, as sort of a witness, or sort of in a certain way, one lives longer than the life of some of these companies, sort of deal with change, right? So you could think about an investment portfolio that you created at a point in time will only have validity for a certain amount of time. And so how does one learn to deal with change? It's a question that I always ask my students, and I would just, how does somebody who has to take the resources of very large numbers of people deal with change? Any thoughts on that matter?
Well, some people try to get on the cutting edge of change, so they're destroying other people instead of being destroyed themselves. And those are the Googles and the Apples and so forth. Other people, like me, do some of that, joining things like Apple, and in some ways we just try and avoid big change that we think is likely to hurt us. And so Berkshire, for instance, owns the Burlington Northern Railroad. You can hardly think of a more old-fashioned business than a railroad business, but who in hell's ever going to create another trunk railroad? So it's a very good asset for us. And we made that success not by conquering change, but by avoiding it. Now, Burlington Northern itself has been quite clever at adapting technology to their railroad. Imagine the good luck of being able to take an existing railroad and double deck all the trains and raise the heights of the tunnels a little and so forth. And all of a sudden you got twice the capacity at very little incremental cost, which is what that railroad has done.
So that is
everybody uses new technology, but it really helps to have a position that almost can't be taken away by technology. How else are you going to carry goods from the port of Los Angeles to Chicago except on our railroad?
In essence, what he did with this talk is remind us that long-term investing is about long-term confidence and stability. Or, like Buffett puts it, there is no penalty for not trying as long as you put your money into some company at some point. And it's always better to miss an opportunity to make a lot of money than to miss a guaranteed payoff. If a really solid company with an excellent track record goes through a difficult period, most people will quickly sell out of their positions. Then, when the company gets back on track, these same people will beat themselves up over selling. Buffett, on the other hand, says, "Be fearful when others are greedy, and greedy when others are fearful." But none of that is possible without a healthy dose of self-confidence, which requires knowledge and understanding of the business, the industry, and it's all connected, and it all requires big patience and self-discipline. And luckily, we've got people like Buffett that are living examples of how and why this works. As a big fan of Buffett, I always enjoy listening to his talks and interviews, and I hope you had fun and maybe even learned something new today. If you did, you can let me know with a thumbs up. and who knows, maybe even a share or comment. I really appreciate it. And well, that is all I got for you today. So thank you all for watching, and until next time, stay very motivated.